whenever market cap gets kind of really ahead of itself, it can be a little bit of a warning sign. So historically, the 4-year cycles of Bitcoin ended with extremely high multiples. That level of euphoria is kind of off the charts.
Today, we'll unpack Lyn's thesis step by step, defining what's really driving Bitcoin's current reset, why the market's internal structure looks healthier than many think, and how broader fiscal trends are setting the stage for what she calls a train that nothing can stop. Lyn suggests that while short-term caution is warranted, especially when valuations get ahead of cost bases, the long-term story remains intact. Bitcoin continues to perform its role as a release valve for global financial pressure. Every wave of volatility resets the system, shakes out weak hands, and hands the keys to those who understand the mission.
Bitcoin has had a handful of like 4-year cycle, ridiculously good fourth quarters. So some of those numbers are insane, and then that can overall skew the whole data set. But so I kind of don't put a ton of weight into that, even if for separate reasons I lean toward this next quarter being probably pretty favorable. I don't really specialize in 3-month predictions, but overall, I do think it's likely going to be a good quarter. Not necessarily because I'm saying, okay, because September was good, I think it's going to happen. It's more like when I look at a combination of things. So some of the paper Bitcoin summer stuff as kind of reset, froth got, air let out of the balloon, whatever analogy you want to use. One of the indicators I look at, again, there's no perfect indicator, but one of the ones I look at is on-chain, market value of Bitcoin, so the whole kind of market capitalization compared to on-chain cost basis, which isn't a perfect encapsulation of things, but it is a useful signal. And when that ratio gets really high, so when market value is really high compared to the cost basis, it tends to trigger more profit taking. The market, the cost base has to catch up for a period of time. Different ways you can look at. So cost basis of an asset overall is basically what price did people buy into that asset. So if you bought your house at a certain price, then regardless of what it is now, you have a cost basis. Same thing if you buy a stock and it either goes down or goes up, you've got a cost base. That's your entry point. And of course, if you have multiple entry points, you can average them together in that weighted way and get your average cost basis. And when we look at, basically market capitalization can be a little bit misleading. Sometimes I use the analogy of a street with houses because it provides a somewhat illiquid example. So if you have a street with 20 houses, they're all $500,000 each, and they haven't traded hands in a while. And one of those neighbors finally sells their house for 600,000. They've sold at 100,000 gain compared to the prior kind of assessed market value. And what will generally happen is all the houses on the street will kind of re-rate higher because now there's a fresh new data point for what houses on the street are worth. In this example, we're assuming they're practically identical. So even though a fairly small amount of capital changed hands, a $600,000 buyer came in and the existing holder sold, if every house on the street goes up by $100,000, that's a $2 million market gain for that street of houses.
Right.
That to a less extreme effect happens in Bitcoin, which is if you've got, pretty tightly held supply, kind of all the fast money's gotten out, what's left is kind of held by, pretty diamond-handed people and entities. And then for whatever reason, there's an influx of new demand, a fairly small amount of income and capital can have a 5x multiple, for example, on market cap because a fairly small number of coins are trading hand. And when we do market cap, we're just saying, well, what's the current price of a coin multiplied by all the number of coins that exist?
Right.
But that's not necessarily the price that it would take to actually, if you want to buy more of them, the price is going to go pretty rapidly. And so whenever market cap gets kind of really ahead of itself, it can be a little bit of a warning sign. So historically, the 4-year cycles of Bitcoin ended with extremely high multiples. That level of euphoria is kind of off the charts.
Yeah.
Another way of putting it is that going back to the house example, if that one house trades hands and all those houses are now assumed to be $600,000 houses, that's kind of a fragile assumption. It says, okay, this one traded hands for that much. But if 4 more neighbors all say, oh, our house is up now, we want to sell, you might not necessarily get 4 buyers in that street for 600,000. So, but after, maybe after 6 months or 12 months, if there's another data point that's at, 600,000 and maybe another data point slightly under, another data point at 650,000, whatever the case may be, it starts to lock in the view that basically this is now the true new market price of the street, at least currently. And the average cost basis is rising because in that one example where the one house trades hand, the cost basis of the street has barely changed. So it used to be the cost basis was 500,000 per house, let's say. One house traded hands for 600,000, so you added 100,000 to the total cost basis of that whole street. But as you get two houses, three houses, four houses changing hands, you're starting to inch up the average cost basis of that street, the actual amount of capital put in as entry prices. And
Mm,
that's kind of it's psychologically important for investors,
yeah.
the price that they entered. And in Bitcoin's case, we of course data is a lot harder to come by than a 20 house street, because we don't know exactly what the volume of exchanges. A lot of it's self-reported. Some of them are publicly traded, so the numbers are more serious. But we don't know the exact volume of exchanges. We don't know every price that everything traded hands at. So, but one of the data points we do have is when coins moved on chain, what price were they at when they moved? And one of the biggest sources of moved coins is coins going to exchanges or from
Hmm.
exchanges. And generally speaking, the moment at which people pull coins from an exchange into their wallet, that's a pretty psychologically important number.
Yeah.
That's like a type of cost base. Even it's not necessarily the price that they bought at, it's the price that they made a HODL decision at.
Mm,
And that's the
yes.
data that we have is kind of just locked in there. And so I do look at the kind of the multiple. So generally speaking, when the market cap gets a little frothy compared to the cost basis, either you're more likely to kind of tread sideways in market cap and cost basis will inch up as more trading happens at that new higher level,
Yeah.
or sometimes the opposite happens and market cap falls quite a bit and kind of catches down if it was kind of a brief uh, period of euphoria.
September, she notes, is historically weak for markets. Traders return from summer vacations, liquidity tightens, and portfolios are rebalanced. But by December, a different dynamic kicks in: window dressing, when funds buy outperforming assets to make their year end reports look better.
So it is historically not a good month for markets as a whole. And this also was an exception for those markets. So stocks did well in September despite historically it not being one of the better months. There are a whole kind of analysts that focus on that seasonality trend. There is pretty good data going back. Some people I think over rely on it. So it could become almost like astrology, like you assume it's going to be bad. But there is some truth to it. I think one of the main explanations for the September effect is that a lot of people on Wall Street are basically on vacation in July and August. It's not really focusing on trading as much. So there tends to be like just lower liquidity. Things are kind of on autopilot. But then once after Labor Day in the U.S., everyone's kind of back, like locked in again, and some of them will reevaluate and be like, "This thing's trading at what now?" And like sell that or like rebalance that, or they kind of get
Mm,
more locked in, and so it kind of sobers up a little bit. Also, the political season kicks into full gear, so things that were kind of on autopilot politically in the summer often kind of get back into full swing, which sometimes has negative catalysts, sometimes positive catalysts, depends. And so, yeah, historically, September is a little bit tricky. And similarly, in December, especially late December, historically, statistically speaking, leans favorable for markets, because there's like they call it window dressing in many times. So the quarter end is very important for many companies, and especially the year end is even more important to the final quarter. So a lot of things are kind of dressed up on their books in the past, like the last kind of couple weeks. There's also tax related stuff that happens, and so it's not really a complete accident that September tends to not be amazing, and September and December tends to be pretty good. Potentially, I think over time that signal could lose some of its value. I don't think that's the case yet because I mean, there's always been a history of like the number of coins that were in Mt. Gox at the peak,
yeah.
the number of coins that were in Binance, the ratio of coins. So these things have always been somewhat concentrated, and even like GBTC. People talk about MicroStrategy getting a lot of coins or BlackRock getting a lot of coins and all these ETFs. I mean, GBTC had well over 600,000 coins before ETFs were even launched and before MicroStrategy got anywhere near as big as they currently are. And so while it is true that more coins have ended up in ETFs and Bitcoin treasuries like MicroStrategy or MetaPlanet, it's we're not starting from zero. We're basically starting from whatever GBTC was, over 600,000. So if the number is twice that, you've added 600,000 coins to those pools, and some of that's not all that's say from self-custody. Some of that is from coins that would historically sit on exchanges, or sit in a little bit more cold storage parts of exchanges, or institutional things like that. So I wouldn't say it has a massive effect so far on the data compared to prior history, but over time, it certainly. I think the part where I call it theater is that this was obvious in advance, I would argue. And as proof of that, I mean, Callahan and I put out a report. So he wrote it, I advised it, and commissioned it on my website. It was started to be worked on in 2024. It was published, I believe, in January 2025. So the beginning
Yeah.
of all this, explaining essentially why nothing stops a train, but in particular, there's a really big section outlining in detail why Doge is very unlikely to have like material macro effects. Not to say that they can't gut program XYZ or do that, but it's like when we're talking the numbers. So we quoted, I mean, they were talking about cutting $1 trillion from the deficit within a year or so. I mean, the initial headlines are basically getting rid of the deficit, so 2 trillion. But then they quickly said, okay, $1 trillion, and we were like, here's why that number is not going to work. So it's not that those effects were undone; it's that those effects were never going after the core issues to begin with, which is if you look at the pie chart of government spending, it's like a really big chunk is Social Security. Another really big chunk is Medicare. Another really big chunk is Department of Defense and veterans benefits, and another really big chunk is interest expense. And those are the things that are either impossible or extremely politically or voter-wise unpopular to cut. The part that they were going after is like the 15% of the pie chart that is like everything else.
Yeah.
The transportation, parks, Department of Education, and like say what you will about those, it's a much smaller part. And those big ones, except for the DoD, like interest expense, Social Security, Medicare, they're not employee heavy areas. They're transfer payments. They're huge monies going around with a tiny fraction of the government employees. And most of the employees work in that other tiny, spending amount, like the FAA or the uh, park and recreation, all that stuff. That's all the employee heavy stuff, but actually ironically smaller spending areas. And so we were like, look, what they're talking about, what they're actually going after is pennies on the dollar. Because they're not going after the core things, nothing stops this train. And then we saw the big beautiful bill came around and just kept the train going. And so where I think it's somewhat theater is that instead of acknowledging on Musk's part that hey, we actually never really had a chance, we were going after the wrong thing to begin with, that would look awful. Instead, someone else has to be at fault. And it's like, well, we were doing this and it would have worked, but you got in my way or XYZ happened. Whereas I argue, no, you were actually not even ever going after the core issue. And then an underlying point, and this happens frequently, is that when difficult decisions have to be made, in politicians will often, and this happens both on the right and the left, is pretend that there's no loser from this, or that the loser is so small and unimportant that it won't matter. And there's a couple ways to do that. One is the grow your way out of it conception,
Yeah.
which, and again, these things work because they have a grain of truth in it. But then it's like, so yes, growth matters, but the idea is that, well, we have high debt, we can just grow out of it. But generally speaking, whoever's holding those bonds and currency is still getting debased compared to whatever you're growing into. For example, often when you see unfunded tax cuts, so they'll cut taxes without cutting corresponding spending, and the argument is, well, we're not really just accelerating the deficit because we're going to get some growth figure that's going to make this all okay, and you never really get amount of growth, so you end up contributing to the total debt. So that's one, and then two, let's say you want to cut spending, and you say, if you tell voters we're going to cut all the things you care about, like good luck, right? I mean, if you look at Social Security, Medicare, I mean, especially the seniors are the ones that vote, um, and they're third rails for a reason, kind of. I mean, the 2010s Paul Ryan era, the Republican Party, they gave it a pretty solid shot to try to trim some of this. Never really had enough consensus to do it. The current version of the Republican Party, the Trumpian part of it, is less fiscally conservative than the 2010s version of the party. They kind of acknowledge these are third rails. And so instead, the narrative among politicians is basically that there are areas of such vast waste that we can cut, and apart from a handful of special interests, it'll be like painless. And the problem is, like again, that's the tiny part of the pie chart. You actually can't do massive cuts unless you're after the really big things, which are either popular among voters, or I would say the biggest area that they could have gone after is Department of Defense. That's the one giant area where there actually is a lot of employees, a lot of spending, and that's, the classic thing of like the Pentagon never passes an audit, despite all the money going there. Now the problem there is less voters and more politicians and lobbyists because every member of Congress that has something defense related in their precinct, which is a really big share of them, will generally defend that thing in their precinct.
As Alden puts it, when the froth clears and the hype resets, the foundation gets stronger. The cost basis rises, conviction deepens, and once again, Bitcoin prepares for its next expansion phase.